It's a funny thing happening in the financial world right now.
Uh-huh.
Typically, if U.S. bond yields are climbing, or maybe if new tariffs pop up, you'd expect the U.S. dollar to be, well, flexing its muscles.
Right. Usual playbook.
Exactly. And historically, whenever things get a bit choppy globally, investors have always made a beeline for the dollar. It's seen as the ultimate safe harbor.
The default safe haven, definitely.
But recently, it's not quite playing out like that. The dollar's actually been on a bit of a slide.
Yeah, I've noticed that slight downward trend.
And instead of piling into greenbacks, it seems some investors are looking elsewhere, eyeing gold, Japanese government bonds, even European debt.
Which is what's so interesting here. That deviation from the well-trodden path of dollar strength during uncertainty,
Hmm.
that default sanctuary status, it seems to be being questioned, at least a little.
Hmm.
This shift suggests maybe a reevaluation is happening.
A questioning of its unshakable status.
Perhaps. The fact that investors are exploring alternatives, even ones with their own issues, makes you ask, what's causing this hesitancy towards U.S. assets now?
That's exactly the puzzle we want to dive into today. Why this apparent cooling on U.S. assets for some investors? Is this just a blip, or is it something, more fundamental?
Right. What's the real story?
To really get our heads around this, we need to talk about U.S. Treasuries. Think of them as IOUs from the U.S. government.
The bedrock, really.
They're the most traded, generally seen as the safest bonds out there. It's a colossal market, what, $28 trillion?
Seriously, yeah. It's huge.
And countries that sell a lot to the U.S., like China and Japan, end up with vast amounts of dollars. For decades, U.S. Treasuries have been the main place to park that cash. China, for instance, holds something like $760 billion worth.
And if you think about the bigger picture, the sheer scale and how easily you can buy and sell treasuries, the liquidity that cemented their role, they're a linchpin in the whole global financial system.
Its stability has always been sort of a given.
Exactly. So even a hint of investors looking somewhere else, well, carries significant weight. Our mission here is really to dissect the reasons why this might be happening.
To understand the drivers behind this potential shift.
Yeah, and to figure out if it truly signals a large-scale walk away from U.S. assets, or maybe something more subtle.
Okay, so let's unpack that. What are the pressure points? What's making some investors, as our sources suggest, feel a bit, well, spooked about holding U.S. Treasuries?
Well, there seem to be a few connected things going on. High on the list are the big U.S. budget deficits and, the growing mountain of national debt.
Always a background worry, isn't it?
It raises natural concerns, long-term, about the health and the value of U.S. debt. Then you add in this sense of unpredictability around U.S. economic policies, trade policies.
Right. Markets hate uncertainty.
They really do. Financial markets generally prefer things stable and predictable. Any wobble can rattle investor confidence.
It's like if the rules of the road keep changing without warning, you might start thinking about, I don't know, taking a different route altogether.
Precisely. And maybe even more significant, there have been instances where the U.S. financial system itself was used as a tool in geopolitics.
You mean like freezing reserves, cutting off payment networks?
Exactly that. For some countries, that's chipped away at the idea of the dollar being this politically neutral, universally safe asset.
Ah, okay. So it makes them rethink how reliant they are on it.
It leads some countries and investors to re-examine that reliance, yes. Now, this hesitancy, even if it's not yet translating into, massive selling,
It still adds pressure.
it contributes to that upward pressure we're seeing on U.S. bond yields. Because remember, if demand for bonds goes down, the prices tend to fall, and the yields, the return you get, move the other way. They go up.
Okay, so there are definitely understandable reasons why some might think about reducing their U.S. holdings. But the source material also really stresses that actually doing it on a large scale is, well, way more complicated.
Absolutely. It's much trickier than just deciding to sell.
Why is it such a difficult maneuver? Why can't they just, move away from the dollar easily?
This is a really critical piece of the puzzle. Let's take China again. Through all those exports to the U.S., they've built up what you could call a giant pile of cash, U.S. dollars.
Right. From their trade surplus.
Even if they decided, okay, we want to seriously cut back on U.S. assets, where they put such enormous sums? The options are surprisingly limited.
What are they, realistically?
Well, they could buy more U.S. stocks, maybe U.S. real estate, or just hold more actual dollars as foreign currency reserves. But holding huge amounts of cash that isn't earning anything, That's not very efficient for a national treasury.
No, it's like having a massive savings account earning zero interest. Not a great strategy.
Exactly. And a key part of this is the ongoing trade situation. As long as the U.S. buys more than it sells globally, dollars will keep flowing into countries like China.
So they constantly have new dollars coming in that need a home.
They face this continuous need to invest those dollars somewhere. They can't just stop buying U.S. assets without ending up with mountains of idle currency.
And the sources also mention some pretty big risks if they did try to sell off large amounts of treasuries quickly.
Yes, serious risks. Imagine a major holder, like China, suddenly decides to dump a large portion of its U.S. Treasury holdings.
What happens then? Market chaos?
Well, you'd flood the market with those bonds. That would likely cause a sharp drop in their prices and send yields spiking upwards. But crucially, that action would also hammer the value of the U.S. bonds that China still holds.
So they'd be shooting themselves in the foot, financially speaking.
In a way, yes. They'd undermine their own remaining position. It creates this powerful disincentive against any kind of rapid, large-scale exit.
So even if they want to diversify, the practical hurdles and the potential fallout make a complete abandonment seem, well, pretty unlikely.
Highly improbable, I'd say, in the short to medium term.
Which brings us to the next point. What could even take the place of U.S. assets? The sources really hammer home the lack of alternatives that match up in size and liquidity.
And the difference in scale here is just, frankly, staggering. The U.S. bond market, we said $28 trillion total, right? It sees over $1 trillion change hands daily.
Wow, okay. That's huge liquidity.
Immense. Now compare that. Gold, yes, it's valuable, maybe $20 trillion total stock, but daily trading is much lower, somewhere in the ballpark of $230 billion.
Still a lot, but not on the same level as treasuries.
Not even close for daily flow. European bond markets, generally smaller, fragmented. Japanese bonds, also huge, but the returns have been extremely low for a long time.
And China's own bonds.
Growing, definitely, but still not as easily accessible for global investors and perhaps not carrying the same level of trust or perceived safety yet.
It's like trying to swap out a massive supertanker for, I don't know, a fleet of smaller speedboats.
That's a great analogy.
None of them individually can carry the same load or offer the same kind of stability on the open ocean.
That's spot on. No single alternative right now offers that same mix of size, safety, even with the current jitters, and that sheer ease of buying and selling huge amounts without moving the price too much. That's liquidity.
And there's another angle too, isn't there? Even if money rushed into, say, the euro or the yen.
Yes, think about the consequences. If everyone piled into euros or yen, those currencies would strengthen significantly against the dollar.
Which sounds good for them.
Initially, maybe. But a much stronger euro or yen makes German cars or Japanese electronics more expensive overseas. It hurts their exports, which hurts their economies.
So they have their own reasons not to want the dollar to completely fall off its perch.
Exactly. They might not want to fully displace the dollar because of the potential negative impacts on their own trade competitiveness.
Okay, so piecing all this together, it sounds less like a panic stampede for the exit.
Definitely not that.
And more like a measured strategic adjustment. One source described it nicely as a shift from everything in the U.S. to let's diversify a little.
I think that captures it really well. What we're seeing are trends, right? Foreign investors may be trimming their U.S. holdings slightly at the margins, central banks adding a bit more gold to their reserves over time.
And more talk about trading in local currencies.
Yes, and more interest in conducting trade using their own currencies, bypassing the dollar where possible. These are all signs pointing towards diversification, spreading the risk. It's not a wholesale rejection of the dollar or U.S. assets.
Because the dollar is just too deeply embedded.
It's still deeply entrenched in the global financial plumbing, despite the current unease.
Now, let's bring this closer to home. For you listening in India, this global financial shuffling, it probably raises questions. How could this potentially ripple through and affect India?
Right. This is where the rubber meets the road for our listener. A weaker U.S. dollar, which could be one outcome of this diversification trend. Well, that could actually offer some benefits for India. For one, it could make imports cheaper. Think about crucial commodities like crude oil, a big import for India. A weaker dollar makes that less expensive in rupee terms.
Okay, that's a clear positive.
And also, if global investors are actively looking for places to put their money besides the U.S., India's growing economy and its financial market stocks, bonds could become more attractive targets for that foreign investment.
So potentially more capital flowing into India.
Potentially, yes. It could be an opportunity.
And the sources mentioned the RBI, India's central bank, isn't just sitting back, it's already taking steps.
That's right. The Reserve Bank of India has been quite strategic, actually, in diversifying its own foreign exchange reserves over time.
How so?
Well, this includes gradually buying more gold, adding to its gold holdings, and also adjusting the mix of other foreign currencies it holds. It's a prudent strategy, really.
To reduce reliance on just the dollar.
Exactly. And to cushion the reserves against potential swings in the dollar's value. It's sensible risk management.
But it's probably not all smooth sailing, is it? There must be potential downsides for India in this whole scenario, too.
Oh, absolutely. The global financial system is so interconnected. If U.S. bond yields were to spike up sharply, maybe because selling pressure does pick up steam, that could easily trigger a ripple effect. We could see foreign investors pulling money out of emerging markets, including India. That puts pressure on the Indian rupee.
Okay, so volatility is a risk.
Definitely. And another thing, the U.S. is still a massive export market for India. Top destination, in fact.
Right.
So if the U.S. economy were to slow down because of its own financial issues, that would inevitably hit India's exports. Less demand for Indian goods and services.
So it seems like a double-edged sword. A world less centered on the dollar could open doors for India, but it also brings challenges that need careful handling.
Precisely. India really needs to navigate this carefully. Manage currency swings, keep exports competitive, and crucially, make sure its own markets remain stable and attractive for investment, whatever happens globally.
Okay, so let's try and wrap this up. The big takeaway seems to be, yes, we're seeing shifts. Investor sentiment is changing. There's a definite move towards spreading bets beyond just the U.S.
A clear trend towards diversification, yeah.
But a full-scale abandonment of U.S. assets, that still looks pretty unlikely, at least for now.
The sheer size of the U.S. market, the liquidity, and honestly, the lack of equally good large-scale alternatives means the dollar is probably going to remain critical.
It's still a cornerstone of the global system.
For the foreseeable future, yes. Which I think leaves us with a really interesting thought to ponder.
Go on.
Well, given this steady drumbeat of diversification and the very real reasons behind it that we've discussed, the debt, the policy uncertainty, the geopolitical uses, what are the longer-term consequences?
For the global financial order.
Exactly. And for the role the U.S. dollar will play, maybe not next year, but in the decades to come. It's a complex picture, and it feels like the story is still unfolding.
Something for all of us to keep watching.